Imagine the US stock market drops 20 to 30%. Most people make two mistakes. One, they panic sell at the bottom. Two, they try to make it back with risky bets and lose even more. In this video, I'll break down 6 real strategies investors use to protect capital, and in some cases profit during market sell-offs. And I'll show you why the idea of a perfect hedge is basically a myth, and what to do instead. And halfway through, I'll explain one popular protective tool that actually traps beginners and why regulators warn about it. Here's the one rule you must remember: market protection is never free. If you want your portfolio to drop less, you'll pay somehow through lower upside, fees, or ongoing insurance premiums. So the right question isn't, what should I buy so I never lose? It's, what's my goal in a downturn? Survive without panic, keeping a clear head while others are fearful, lose less than the market, or try to profit while the market falls. For decades, the simple plan was, when stocks fall, bonds rise. And often that's true. But there are periods when both fall together, especially when inflation is high and interest rates are rising. That's why you don't want one magic product. You want layers of defense. I'll walk you through these layers from the simplest to the most aggressive and show who each one is for. The most underrated protection is also the most boring: cash and short-term treasuries. This isn't about getting rich during crashes. It's about avoiding the number one killer: panic selling. When you have a cash buffer, you don't need to sell stocks at the worst time. Instead, you have dry powder to buy when prices are cheaper. It helps you stay calm and gives you money to buy dips. Okay, but what if you want to stay invested in stocks, just with less pain? That's layer 2, low volatility and defensive sectors. Layer 2 is staying in stocks, but choosing less volatile stocks. This is where low volatility ETFs and defensive sectors come in. The logic is simple. Some businesses are more stable in downturns, like consumer staples and healthcare. People still buy essentials. Important, this is not a crash-proof shield. These are still stocks. They can fall in major bear markets, but often they fall less. Now, what about assets that sometimes do better specifically when fear spikes? Layer 3, long-term treasuries and gold. Layer 3 is adding assets that sometimes hold up when stocks sell off. When investors expect recession, money often flows into treasuries. Gold can also act as a fear asset. But here's the key: neither is guaranteed. If rates are rising, long bonds can drop hard, and gold doesn't have to go up every time stocks go down. So think of this as diversification across different market environments, not a sure thing. Those were the survival and smoothing tools. Now let's talk about ways people try to actually profit during crashes. Managed futures and trend-following strategies are designed to potentially profit from big sustained moves up or down. In simple terms, if markets trend down, the strategy can position for that downtrend. If markets trend up, it can flip. Crises often create strong trends, but the trade-off is real. In long bull markets or choppy sideways markets, trend strategies can underperform. They can lag in calm or choppy periods. Now here's the tool beginners buy as protection and often get burned by. Layer 5, inverse ETFs. Profit from drops, but easy to misuse. Inverse ETFs move opposite the market. Market down, they go up. Sounds like the perfect hedge, right? Here's the trap. Many inverse ETFs are built for daily performance. That means their target is the inverse return for one day, not for months. In volatile up-down markets, the daily reset can create surprising results over time. Professionals treat these as short-term tactical tools. Layer 6, options. Real insurance, but it costs money and skill. A protective put is basically real insurance. You pay a premium to limit downside. Like car insurance, you pay even if nothing happens. The opposite is selling that insurance. Options can be powerful, but they require education, discipline, and risk management. They're not beginner toys. They can cap worst-case losses, but cost premium. Let's turn this into a simple plan. Step 1, pick your goal. Step 2, build your foundation with cash and defensive stocks. Step 3, consider a small allocation to trend strategies. Step 4, understand the mechanics of inverse ETFs and options before using them. Markets will fall again. That's not a bug. It's the system. Your job isn't to predict the bottom. Your job is to build a plan so you don't panic. This is an educational video and not financial advice. I'm not aware of your personal situation. Please do your own research and speak with a professional.